We are going to read line by line almost the pamphlet that you can find on the Cmhc website. Hi everybody, I hope everybody's doing fine. Today I'm making a video because I want to introduce to you the MLI standard program from Cmhc. In my previous video I have explained shortly what a commercial loan is. Now I'm going to dig into a little bit more detail for a commercial mortgage loan and also insured by Cmhc. So also you'll notice that in this video I have a notepad with me because the program has a lot of criteria, a lot of details. It's very elaborated, and I'm gonna scratch most of the program, but there's still some specificities that I won't go into, but you'll get the general idea of the program. And basically how I'm going to structure the video today is that we are going to read line by line almost the pamphlet that you can find on the Cmhc website for this program, and I will give comment and explanation along the way, but this is how I will present the program today. And also to give you a disclosure, a lot of these information are valid today, but they might not be valid in 6 months time, in 1 year time, or even in 2 years, because programs, as you know, change all the time, and also variable for loan change all the time. So it's important to grasp the idea, but also each condition for each lender could be different, but at least you'll get a good idea of what the program is today, and I hope you enjoyed the video. So let's get started. So first of all, I want you guys to know what is Cmhc, and to best describe that, I have found the definition on Cmhc website. So basically, the Cmhc is Canadian Mortgage and House Corporation, is a crown corporation in Canada whose mission is to facilitate access to housing for Canadians. It offers various services, including mortgage insurance, which we are going to discuss today, financing program for house project, and research on real estate market. The Cmhc plays a key role in stabilizing the real estate market and improving house condition across the country. So like I said, to the best of my knowledge, I will go through the criteria of this program called MLI standard, standard with a D. I just did the video in French, so excuse my French. Yeah, and basically, let's go ahead with the criteria of this program. So MLI, okay, you can have residential insurance for your loan, like a regular house or anything below 4 units. But in this particular video, we're going to talk about the MLI standard for first criteria, 5 units or more. So we are going to talk about a commercial loan today. Across all financial institutions, it's most likely known that 5 units or more in the residential sector is a commercial loan. So the first criteria for this is to have at least 5 units on the building, okay? The second criteria is that you have to have at least 70% of the total area plus the total loan value in residential, okay? So you can see that sometimes some buildings, multi-residential building or 6 or 12 units, have a portion of commercial downstairs, okay, on a popular street or no, but it's important that this portion of commercial does not exceed 30%. Otherwise, this program will not apply. The third condition, LTV means loan to value. We're going to come back to it and we're going to calculate it later on in the video. But most likely what it means is that the total loan amount cannot exceed the value of the property at 85%. So to put this in perspective and into numbers, if you have $1 million valuation on your building, the loan cannot exceed 85%. Past this pass this threshold, the loan does not, the insurance does not apply to your case. The fourth criteria, so I just wrote law, non-Canadian act, but I'm going to read it. So it says, must not be subject to any prohibition under the prohibition on the purchase of residential property by non-Canadian act. So if I'm not going to read the entire law. If you want to figure out about this, then you can go on your own and figure out exactly what it is. Basically, it just means that you have to be at par with this law. For the fifth criteria, recognize competence in management a property of similar type and size, okay? So fifth criteria, recognize competence in managing similar type and size. I put type and size asset here with a little line here because the type in commercial banking can be very different, okay? It can be semi-commercial, could be fully residential, could be more commercial than residential. There's all kinds of type of assets, so you need to have some experience in the same type of asset, and the size matters as well. So let's say that you have a real estate park of 6 unit, 12 units, and a 20 unit. So it's a decent size of a real estate park, but let's say that you want to apply for an insurance and a loan for a 220 units building. It's not going to work out, okay? But there are ways around this, legally, of course, is if you have a managing firm that will sign on this acquisition, that they will take care of the assets once you did the loan, then this can work as well. And something else that you can add for your demand is a manager that has 5 years of experience. Could be a partner, so a shareholder of the company, because most of the time in commercial banking, it's no longer people like me and you, physical, that purchase the assets. It's through management companies, through trust even, or to other sets of companies as well. So it's important that the physical person at the end of that line has at least 5 years of experience and for similar type and size. So one way that you can do it is, yes, with a management company, but another is to have a partner with a percentage of ownership of the entire structure. And for the criteria number 7, the criteria number 7 says net worth 25% of the loan, and also it has to be not less than $100,000. So basically what we mean by this is that if your loan is $1 million and you need to demonstrate that you have 25% of net tangible value. I'm going to come later on in the video to explain you how we calculate the net tangible value, but basically you need to have 25% of this on your loan, of your loan. And the last criteria, number 8, is the ability to guarantee 100% of the loan for the first 12 months until the rent is stabilized. And we're going to talk about rent stabilization for a minute here. So when you have a construction project, so you basically want to raise up a building from the ground up through construction and then a loan and all that stuff, there's a period of time where you will be not collecting any rent because the building is building currently. So maybe at 80% of completion, tenant can come in this property, but for the time being, they cannot, okay? So that's why we ask 12 months of stabilization, because even though when the building is fully constructed, it might take some time before you fill it up with tenants. And this is also true in acquisition, and it's also true in refinancing, okay? Because in acquisition, when you purchase a building, your purpose might be to optimize this building. Maybe you buy an old 12 unit that you want to renovate completely. When you do that and you change the you change the purpose of the building, then there's a lot of tenants that are going to be out of this building. So your rent will be partially affected or fully affected if you almost, I don't want to say destroy, but if you want to rebuild the entire building from A to Z. So this is important to be able to guarantee the loan to 100% for 12 months, 12 consecutive stable months. And so these are basically the 8 criteria for the program of MLI standard, okay? And I want to put an emphasis on this, that I'm talking about the program MLI standard and not select, because they're 2 different programs, and I can address the other program in another video, but for the time being, I want to start with this one, okay? So now for the next part of the video, what I'll do basically is that I'll show you to the image the pamphlet of the CMHC website, and I'm gonna read it line by line with you and maybe provide some experience example throughout the reading, so you guys can better understand what's happening. Pamphlet starts, it says at glance, loan purpose, construction financing, purchase and refinance. So these are the 3 type of transaction you can do. These 3 types of transaction most likely covers all the transaction in real estate. There's some exception, of course, but for the most part. Property type and size. Project providing standard rental house, self-contained unit, and minimum project size of 5 unit. So it is for renting a unit, and it is for 5 units or more. Non-residential component, not exceeding 30% gross floor area, nor 30% of total landing value. Loan relating to non-residential component must not exceed 75% of the lending value of non-residential component. So basically, the maximum loan for this part is 75% of the commercial value. So I'm gonna erase this and demonstrate you with an example on the board. So here's the example that I drawn. So basically, if you have a construction cost of $10 million, 30% of that is $3 million for your commercial space, okay? Basically. And as I mentioned in the pamphlet, it says that you cannot, the construction, the loan to value of the construction part cannot exceed 75%. So if my commercial spot in construction is worth $3 million, that's what it's gonna cost me, I can only finance up to 75% of that $3 million. So $2,250,000. So that's pretty much the example for that part. Because remember that this program is not made for commercial unit, commercial space, although it does include and offer a certain flexibility if you want to do that. Okay, so back to the pamphlet, maximum loan to value. Construction financing, up to 85% of the lending value as determined by CMHC, or 100% of cost, whichever amount is less. So for example, that the building that I want to build is estimated by the CMHC to, let's say for example, $10 million, okay? So my loan to value would technically be 8.5 million. So that would be my financing at 85%, okay? But however, the construction material costs me $8 million. Therefore, CMHC will take the financing on the lowest of both amounts. So it would be $8 million that they base their amount on. That's for construction financing. Purchase, up to 85% of the purchase price or lending value as determined by CMHC, which amount is less. So it kind of speaks for itself. If you buy a building for $10 million and the CMHC evaluate that this building actually is only worth like $8 million, you will get financing on the $8 million value figure instead of the 10. And for refinance, up to 85% of the lending value is as determined by CMHC. And for purchase/refinance with improvement, up to 85% of the as is or as improved lending value as determined by CMHC. So now there's an important question here, and it will be important for the rest of the video, is how does CMHC determine the value of the asset that you want to acquire or refinance or build? So I have an answer for you, and I have to flip the board for that. Okay, there's a lot of information here, but we're gonna go one by one, okay? And for the following of the video, it's important that you try to keep track and you listen to 100%, because I will make links between things in the middle of the board to the bottom and to this one, to that one. So I'm gonna go all over the place. So if you want to make sure to follow and not re-listen three, 4 times this video, I would recommend that you drop what you do now and you listen 100% and give me 100% of the attention. So for the valuation of a building by CMHC. So what is CMHC gonna do? So I take, for example, here as well as a disclosure that my value used here in $ makes no sense, okay? It does not make sense because it depends where the area you are, how much the city will charge you in tax. It depends how much the average rent is in your area. For my example here, I took a $1,900 average rent in a 40-unit building, okay? But every 40-unit building has their own criterias, and also depending where you are located, $1,900 average rent might be a lot of money, and for some other people in other area might be not a lot of money. So keep in mind that, again, I just want to fill value here and that you understand the relationship between the numbers. So let's go with the example. If we start from here, as I said, I have 40 units at $1,900 per month. Gives me that per year, okay? $912,000. So the first thing that you're gonna have to remove from your, I'm just gonna move this because I'm gonna stay here for a while and we don't see much. So basically the first thing that you're gonna remove from your income is the vacancy rate, okay? So I wanna touch on the vacancy rate and the normalization, okay? So I just touched 2 things, normalization, vacancy rate. If we go on this side of the board, you can notice that I put normalization here with few different things. Repair and maintenance, salary, reserve for, sorry, like I said, I just explained that video in French and I need to change a few words. Reserve for appliances, management fee, and vacancy. So the first thing, the normalization basically is what CMHC is going to use for your expense account and for your vacancy. And this is based on their average, on their database, whatever, how it's based on, it's on their stats. And they're going to use that for most of the file, if not 100% of the file are going to use that. So let's take, for example, the vacancy, okay? I have chosen a vacancy of 4%. We have noticed in the market that any rent above 2,500 or 2,600 has more vacancy than lower amount. And the vacancy currently, as we speak now, could be between 2% and 8%. But this is any classes of asset combined here, okay? In the most case where you're gonna find vacancy rate at 8% is most likely in retirement homes, okay? Because the retirement home industry took a big hit during COVID for various reasons, and that is a video in itself, and I might do a video on that class of asset, but for some region and some area, CMHC is going to use a normalization vacancy rate of 8% for their valuation of building. I decided to take 4 for my apartment building for, let's say, the region that I chose. So that's the first normalization. So 912,000 minus 4% of that equals 36,400. So it's going to give me an effective gross income of 875,520. So the effective gross income is an important number here because we're going to use it later on, okay? Of this amount here, we're going to reduce the effective gross income by these expenses account, okay? So if we start with the first 3, okay? Taxes, insurance, and utilities. These values that you're gonna have here are gonna be the values that you have in your professional evaluation of the building, okay? And these are 1-per-1 number here. So if the taxes is evaluated to be 190,000, it's gonna be 190,000. If the taxes are estimated to be 60,000, it's gonna be 60,000 here. Depends on the evaluation that you're gonna make. Insurance, you need a quote for that if you don't have the building built up yet, but if not, the evaluation will provide value on this. And utilities, then again, you either need an evaluation on that or comparables, or if the building is already off the ground, then it's the same number here. For the rest of these things, I'm just gonna put an X here because we covered that. For the rest of these expenses, now we're gonna go with the normalization, okay? Normalization means that the CMHC has enough information to provide you with a guideline where you should base your calculation. So for example, repair and maintenance. If we go to the tab here, repair and maintenance have a $925 per door per year as an expense. So I have $925 times 40 units will give me an expense here of 37,000. And it's the same thing for salary per door per year. 610 times 40 units equals 24,400. Now it changes a little bit. Here is reserve for appliances. So basically when you move to an apartment building, that building might already include some appliances. In most cases, for the new project, new construction, it comes with that. For the sake of this evaluation, for the sake of this video, what I chose is, and by the way, it's $60 per appliance per year, per month, sorry, yes. So for this video, you do 60 times 40 units, and I put a 2 in bracket here because I figured 2 appliances per unit, so oven and fridge. So it's $120 per month per door. It's gonna give me 57,600 for that expense. So we just covered repair and maintenance, salary, reserve appliances. Oh, management fee I have not done, okay. And the last one, because we did vacancy here, the last one is management fee, okay? And I just mentioned earlier that we're gonna use this number down the road, and this is where we're gonna use it. So the effective gross income has to be multiplied by the management fee of 5% in normalization to know exactly what is this expense amount. And you might ask yourself, what is a management fee? A management fee is basically the firm that is going to take care of your building, or it's a fee that the CMHC takes into consideration for these classes of assets, okay? Because most of the time, in a lot of portfolios, because most people that own portfolio do not manage their own building. They have a professional management company to do it, or they have their in-house management company to do it. But regardless, this management company needs to pay salary. And this is where that a 43,776 comes from. I also put a other because some classes of asset have other expenses than that. And keep in mind that this is a very general video, well, a little bit more precise, but still, you could have other expense as well, but for the most part, that's what it is here, and the vacancy. So when you have calculated all of these things, you have what's called here, from the bottom up, an NOI, okay? NOI is net operating income. It's basically your revenue minus all the expenses account. And for our case, we have 402,744. Now we're gonna come to the part where the valuation is done, okay? We have what we call in the industry a cap rate, okay? That you can find on the CBRE website or on the evaluation. I don't want to dig too deeper on the cap rate because it is a value that is obtained by doing all sorts of calculation and comparables. And that by itself, with the theory and the explaining, is a video of maybe 1 hour, okay? So for the sake of this video, I just assume that my cap rate is 4.5%. This is a low cap rate, by the way, for a type of asset. And I think it's very reasonable for what I have here, but then again, this depends a lot on the region you are and the risk as well and the value of the property around it. Like I said, it's a video on its own, so 4.5% for now, okay? And then this is where the value, this is the calculation of how we get the value of your building. We take the NOI, the net operating income, and divide it by the cap rate. So in our case, 402,744 divided by 4.5% equals 8.9 million. There's some other stuff, but I just ran out of space. So I put little waves here. So basically my building, to the eyes of CMHC, would be worth $8.9 million. Okay, so that is how it's valued. But it does not end there because there's other criteria in this program, and one of them is the LTV, loan to value. So how much of a loan on my value do I have? So I calculated 67%. And how did I get this number? Like this. So again, everything is fictive here. So these are the parameters that I decided to do the video on. A loan of $6 million, a term of 3 years, a rate of interest of 4.68%, amortization on 50 years because it's a brand new building that I'm building. If it wasn't, the maximum amort would be 40 years, but that I'm gonna touch on the amortization period on this program later on. So my payment yearly is 310K, okay? The DCR I'm gonna come later on, it's a future topic, but what it basically gives me, the way that I calculate my loan to value is like this. So I'll take my loan amount, which is here, $6 million, divided by my value that I just calculated, 8.9 million, will give me 67%. So I have other stuff on the board, but I will come back later on to it, okay? Because I have other subject to touch, but yeah, we'll come back to it. So back to our other side. Now that you know how to calculate the value of your project, or through the eyes of CMHC. And by the way, CMHC reserves themselves to change whatever parameter that I just showed you before. So you might have an idea or an understanding, but generally speaking, this is what it is, but it might change. Everything is, it should be like this, but it's not always like that. So back to the pamphlet, we're gonna go to loan advancing. So loan advancing for construction financing says during construction, the loan can be advanced up to 75% of the cost or lending value, whichever is less. Advancing of additional fund is subject to rental achievement. And rental achievement, we have discussed about this, but is basically the target for the building to achieve a positive cash flow and being able to serve the debt. It can be various amounts. It could be 85% lease, it could be 95% lease, it can be 100% lease. It depends where you meet your threshold. And also, we're just talking about the building being optimized to get your 85% loan to value, but there's 3 ways you can do that. The first one is to be able to serve your debt, like I just said. The second one is to have 12 months of stabilization of rental income, revenue. And the third one is that the project has been built, because we're talking about construction financing, the project has been built for 24 months now. So these are the way that you can have your 85% loan to value. For the construction costs are to be reviewed. I'm back to the pamphlet now. Construction costs are to be reviewed and recommended by quantity cost supervisor. Flexibility may be provided in small market. Okay, so what is the quantity cost surveyor? Okay, this person is one of the most important of the entire project when you're building, because he is the one that estimates the cost and also the number of advancement that you're gonna need for the loan, and also the bank, because the bank is the lender. But basically he will say, okay, this project is costing you, let's say, like $50 million, and we're gonna do it in 10 increments of $5 million, which is possible. It's a construction loan, there's multiple advance. So basically the lender will have to sign off on this. But there's something interesting here, and I make a very extreme example here. Let's say that you need a $50 million loan. You will not be able to do 50 withdrawals of $1 million, because depending on the size of the project, the bank will put a threshold of a minimum advance required. So in a case of, let's say, a $10 million loan, it might be an increment of 2.5 million or 2 million, depending on the size of the project and also the borrower. So that's that. Also, back to the pamphlet, construction must be completed under a fixed price contract with a general contractor or under a construction management arrangement. Okay. First and last advance must be approved by Cmhc. And the lender has the option to approve advances occurring between the first and the last. So a lot of information said, but not too complicated. Okay, so basically the Cmhc does not carry the burden to verify if the borrower is good and so on and so forth. They do look at what the financial institution is going to propose to them, but if the financial institution is good to go with this type of borrower, the Cmhc usually follows, maybe does little tweaks here and there, but usually they just follow. So basically, let's say that we have 5 disbursement advance, whatever you want to call it. Let's call it disbursement for now. The Cmhc will want to have a say on the first one to approve that everything is fine, and on the last one to give the last slice of the loan to value that can reach 85%. Between that, if we have 5 disbursement, all of the other 3, it's free to the financial institution to see how they want to do it. Back to the pamphlet, purchase or refinance of existing property with improvements. So there's 2 things here. The first one is where rental income is not disrupted during construction, the loan advance will be limited to the greater of 75% of the as improved value or 85% of the as is value. So basically 75% of the post renovation value max, or 85% of the current value, whichever is higher, if the revenue rental income is not disrupted. Okay. On the flip side, if the rental income is disrupted, the maximum advance allowed during construction is based on 75% of the as improved value, advancing of additional funds is subject to rental achievement. So we just spoke about the rental achievement. It really depends on the project and the size and so on. So basically this is what it is for those two situations. So now we're going to discuss a little bit more about the rental achievement. So in the pamphlet it says rental achievement where loan advance are required above 75% level. Authorization to advance will be given by the CMHC once the approved lender has provided evidence acceptable to CMHC that the property has achieved the projected rent level. As just mentioned before, the CMHC does not carry the burden to gather the proof, to build the file, to make sure that the borrower is capable and to ensure the performance of that loan. They're just there to ensure the loan, okay? The CMHC will wait until the financial institution gives a tangible explanation that the projected rent level has been achieved, and they're okay with that. And then they will provide the proof to CMHC and then move on with the project. So we have now on the pamphlet the minimum debt coverage ratio requirement, DCR. What is that? How you calculate it? And what are the impacts? So I just want to touch on this board that I will put on the screen. So you have two separate things here, the residential space and the non-residential space. And the subcategory is rental property with 5 or 6 units, 1.10 for purchase, 1.20 for refinance. And for rental property with 7 units and above, 1.20 for terms of 10 year plus and 1.30 for terms of below 10 year, okay? There's one important information here that I want to put the emphasis on, and is the term, okay? The term of the facility will differentiate depending on the size of the loan and the style of the asset, okay? So for example, and also the sophistication of the borrower. So let's say, for example, that you have a hospital that needs to be constructed and it's a loan for $282 million, okay? Most likely the term is not going to be 3 or 5 years. It might be 15 years on that facility, 10 years, or maybe sometime even longer, okay? But the borrower behind the hospital here in Canada will most likely be the government. So that's like type A borrower, the best one. So the financial institution is more comfortable to make a longer engagement, because the term is an engagement with that borrower, because they know that they have not a lot of risk. So we can see here that it reflects on the DCR, because any 10 years plus term has a lower DCR, so a lower requirement to cover the debt than a lower term. So DCR, how are you computing it, calculating it? It's right here, okay? So in order to calculate that, you need to have a loan value, a rate, an amortization period, and the payment per year, okay? So my payment per year on my $6 million loan is $310,000, okay? So that covers my payment here. And the NOI is what we calculated here, is the top part, and it gives me a ratio of 1.30. So I am under 10 years, so basically I would pass flush on my loan. But there's something else that is included in the payment, and it's the insurance fee. And this might disrupt, well, this will disrupt for sure my DCR, and the loan might just not pass. So we're gonna come back to this. But for the DCR, this is how you calculate it. And also there's the non-residential part, which has a higher DCR, because the commercial unit is a little bit more risky. Like I said before, It depends on the tenant. Some businesses, let's say for restaurant, that are most likely tenants in the building that you have, they don't survive very long. The food industry, especially for restaurant, is a very tough industry to deal with for many reasons, and we can do a whole video on this, but the labor has a high turnover, the inventory is perishable, the location has a big affectation on how much you're gonna sell, weather. Sometime here in Quebec we have 4 weathers, so it's not always easy. Also the reputation of the restaurant. So all these factors come hammering on this type of business, which makes them extremely difficult. But it's not only for that, but it's part of the reason why. So now I'm going to talk about, we're going to go back to the pamphlet, and I'm going to talk about the interest rate follow on. Fixed interest rate or floating with ceiling rate. So what is a ceiling rate? It's basically the maximum rate of interest that you can go to make that loan. And if you surpass that rate of interest, then the DCR does not work anymore, and probably some condition as well neither. So you need to write at which point you have a breakage on these conditions. So amortization. CMHC may consider amortization period up to 40 years for existing property and 50 years for new construction. A premium surcharge applies for amortization period greater than 25 years. The amortization period must not exceed the remaining economic life of the property as determined by CMHC. So, 3 things here actually. We have amortization period, 40 and 50 years. So for new construction, it's 50 years, new project. And for existing ones, so refinancing or purchase is 40. Another thing is the economic life of the property, okay? So the economic life of the property is how much, on the evaluation, you're gonna have how many years your property has left to be standing like this. So for example, that you have a professional evaluation and it's written on it that the building may survive for another 37 years, okay? That means that the CMHC will most likely not go to a 40-year amortization if you purchase or if you refinance that. And on the counterpart, if it says that your economic life is like 45 years, then the 40-year threshold is not a big problem. But they really follow the professional evaluation that you have. And the third thing that I want to touch on this point is the surcharge, okay? CMHC, the fees are broken down into 2 things. First one is the insurance premium and the second one is the demand, right? On the CMHC premium, insurance premium, any loan that exceeds 25 years of amortization per slices of 5 years has an extra 0.25% surcharge on their certificate. So basically, if you have a 50-year amortization for your new construction, you pay 0.25 5 times. So let's say that your certificate was initially at 4% at 25 years, then it would be 5.25 since you're adding 5 extra slices. Tranches if you want per se. So that's covered. Back to the pamphlet now. Security type. First, second, and pari passu mortgages are permitted. Second mortgage are permitted as interim measure. For how long? So second mortgage are permitted as interim measure. So what is a first, second, and pari passu mortgage? Okay, a first mortgage is a senior debt. Second rank is a junior debt, and a pari passu is when 2 or more financial institutions are coming together to make that loan. So that's allowed by the CMHC. So a senior debt is basically the first debt that are gonna get realized, that they're gonna get refunded if there's a default on the loan, and the junior debt comes second, okay? But the rank of who gets paid first depends on which kind of creditor are on this building or this class of asset. So you have 4 types of creditor. You have the secured, preferred, ordinary, and deferred creditor. Honestly, I just opened a little bit on that, but the type of creditor, the liens, the senior debt, the junior debt, pari passu mortgages, and also, you know, secured, preferred, ordinary, deferred. This is a video by itself for 1 or 2 hours, and it requires a lot of attention as well. I don't want to dig too deep on that, but for the video today, the security type that is allowed is the first, second, and pari passu mortgages. It says that the second mortgages is an interim measure. However, there's no information on the CMHC website for how long you can have this second mortgage. So if you know, please comment below, because I was not able to find the information. And if you have experience in this, I'd be happy to know for how long you can have the second rank. Honestly, for my personal opinion, I think it's probably for 1 or 2 or at most 3 years, but then again, I don't know. Back to the guidelines. General guidelines for borrower eligibility. So the borrower must demonstrate competent and experience with the size and type of the property for which mortgage loan insurance is being sought for. The borrower or a corporation affiliated with the borrower must have at least 5 years or demonstrated management experience in the operation and management of similar multi-residential unit properties. Alternatively, a formal property management contract must be in place with a professional third-party property management firm. So basically, to come back on the 5th and 6th point at the beginning of the video, you need that experience with that class of asset. Otherwise, you know, you don't even qualify for that loan. However, if you have a partner, somebody that has share, doesn't need to be 50-50%, it can be 5%, 3%, 1%. As long as you have somebody involved that has this experience for this type of loan, then your loan most likely might be approved. Borrower net worth. The borrower must have a minimum net worth equals to at least 25% of the loan being requested, with a minimum of 100K. So here I just want to drop my clipboard for a moment and demonstrate how we calculate the net tangible value of someone. All right, back to the program. So here I listed few things for the net tangible value, okay? And this often is where we have a lot of confusion for the borrower. The net tangible value is calculated for the physical person that will ultimately contract that loan, and we need to figure out how much this person is worth, okay? And how do we do that? You can borrow money on your business and holding company, but however, you're gonna need to make this at some point for the majority of the shareholder of that business if you want to make that loan. Or let's say if you have 10 shareholders and 1 shareholder net tangible value is sufficient to cover the loan, then maybe we're not gonna ask all the 9 other people, but for the most part, you're gonna need to fill out this for the most shareholder on this loan. So basically what we're gonna require is to know the salary of the person, and you need a T4 or something tangible to demonstrate how much money you have made, or some sort of tangible proof of how much of income you are making. Because if you do not provide a tangible proof for this, we're not gonna take it seriously. And the other thing is, it could be a low salary, it could be $0, but you have to demonstrate some sort of a net worth somewhere. The other thing that we're gonna ask for this is the credit check authorization. So we're gonna ask you to check a box and give us the consent to verify the credit from TransUnion or Equifax so we can have your liabilities, okay? And the other thing is general information. So we're gonna have your social insurance number, your full name, your date of birth, where you work, your address, your second address, you know, general information to make sure that you are the right borrower and we are not doing any money laundering, or just that we are dealing with the right person. So I think these are just, these information just makes sense. And this is where I want to touch on, and it's the assets, okay? So when we fill up this, the second part of the net tangible value form that we're gonna have to fill up with you is for the asset, okay? So the asset, let's say that you write on this document that you have $100,000 in your checking account and $1 million in your saving account. And let's say that you have a company that is worth that much amount of money and your house is worth $1 million. We're gonna need tangible proof of all of this, okay? For the account and investments, we're gonna need 90 days, so 3 months of a statement for these accounts. So for the investments, it's 90 days. For the checking account, saving account is 90 days. Otherwise, it's not gonna be taken into consideration. For houses, real estate, and all that stuff, a lot of people give the market value, if you want, quote unquote. But if you do not have a professional evaluation on your pieces of real estate, what bankers are going to do, what commercial loan broker are going to do, is we are going to take the municipal evaluation on the class of asset that you have with the address, and then we're going to apply it to the current mortgage if there's a mortgage left. And most of the time, and I want to say 99.9% of the time, the market value of your house is not the same as the municipal evaluation. If you do not have a professional evaluation made on your piece of real estate, this is what we're gonna take. And it's the same thing for any class of asset here, okay? Car, boat, whatever type of asset that you might have, we're gonna need a tangible proof for this. And we are in Canada here. Any asset that is not in Canada will not be accounted for here, or unless it's a very, very specific class of asset and it's provable. It might help for the qualitative of the file, but for the quantitative, it's zero value if it's not in Canadian soil. And the liability, okay? So the liability will be most likely obtained from the credit check. So we're gonna apply on mortgages, credit card, line of credit, whatever credit that you have, you're gonna be in liability. And we're gonna do the summation of assets minus liability will equal your net tangible value. And this is the 25% we were talking about at the beginning of the video. And this is where we're gonna see the solidity of the lender. And I wanna touch on this because Cmhc has a preference when it comes to net tangible net worth. So let's say that you have $8 million sitting on cash, okay? Cold hard cash under your mattress. This is not a collateral that Cmhc particularly like because it's very liquid, it's very movable, and it can go away tomorrow, okay? So they'd rather have equity on buildings or something that is somehow liquid, but not cold hard cash, okay? So this is something that happened in a file, but anyway, more on that. So back to the program to guarantee requirements. For construction financing, the borrower and guarantor must provide their covenant guarantee for 100% of the outstanding owing under the housing loan from time to time until stabilized rent has been achieved. Next page. for 12 consecutive months, at which time the additional guarantee required may be reduced to 40% of the outstanding loan amount owing under the mortgage from time to time. So when you achieve stability in your new project, then it's going to reduce from 100% to 40% of the outstanding loan. So I think it's pretty self-explanatory. And for purchase and refinancing of existing property, for a new loan on existing residential rental properties, the guarantee amount required by CMHC is 40% of the outstanding loan amount owing under the mortgage from time to time. Same thing, plain vanilla, 40%. That's it. Limited recourse, where a loan does not exceed 65%. This is interesting for low loan to value of lending value as determined by CMHC. Approved lender may request that the loan may be considered non-recourse to the borrower. The recourse of the approved lender shall be limited to the property and the other asset taken as security. So basically, no guarantee amount required if at 65% or less LTV. And not personally against the borrower, CMHC may require additional risk mitigation measure as it deemed appropriate. Example, equity, retention, replacement reserve, collateral, security, personal guarantee. CMHC mortgage insurance provide access to preferred rate, lowering borrower costs for the construction, purchase, and refinance of multi-residential unit properties, and facilitate renewal through the life of the mortgage. And this is correct, and that is true, because CMHC provides a security to the lender by giving insurance, okay? So they may not ask you to put a guarantee amount, but as said in the example, equity, retention, replacement reserve, collateral, security, personal guarantee may be asked for the specific project. I've seen in some project for a retirement home that they asked us for a replacement reserve of X amount per month. And in this particular client, he had a CMHC loan for quite some time. The reserve was so high that the client has made a request to us to ask CMHC if we could remove the debited amount per month. These type of situation can happen. So back to the pamphlet, we have read the entire first pamphlet, okay? There's no other pamphlet for the MLI standard program, but there are few details that I want to go over. And this is the application fee and the premium, okay? This MLI program insurance costs money, okay? And it's broken down into two sections. So I'm gonna put to the screen the other pamphlet and also the links for the video. But the two section of this is the application fee, okay? And there's a big paragraph here. I'm gonna read it and then we're gonna debrief on it, okay? So application fee. The application fee are based on a per unit bed basis, per unit / bed basis, and are payable by the lender at the time of the application. If the application is declined by CMHC or withdrawn by the lender, listen to this, CMHC will retain a portion of the application fee, minimum of 10%, which is its opinion covers for the work done and resource used in the processing and reviewing of the application. There's other things written down, but I want to touch on this, okay? So basically, if you apply for a loan at CMHC through a financial institution or whatever, you need to be sure, okay, that your banker knows what he's doing, or being sure at like 95, 97%, because if they do not approve the loan, you basically lose a minimum of 10% of your application fee. And you might say, well, what is the application fee? And I'm going to come to it right now. So the application fee is on this board. I'm gonna put the board to the screen, but it's in the same pamphlet. And I want to attract your attention on two things here, okay? Base application fees on the left side and base application fee on the right side. The left side says greater than 2 advances and the right says up to 2 advances. What are advances? They're basically disbursement, okay? So in a greater than 2 advances, it might be a construction loan, and this application fee can go up to $55,000 per loan, okay? But it depends on a lot of things. It depends how many doors you have, it depends the commercial space, so on and so forth. But let's say, for example, that your application fee was $12,000, okay? $12,000, if it does not go through, the CMHC will retain at least $1,200. And this is not including the cost of doing an evaluation, not including the architect, not including the banker's fee, not including this, not including that. So honestly, in commercial, you want to make sure that your loan goes through. Otherwise, you're just going to lose a ton of money and a ton of time, and you're going to be frustrated and probably never do a commercial loan before. But commercial loans are a very tedious task, but they are the one that move the needle in a bank, okay? Why? Because these are big amount, they're big project. It's also what brings company to the next level, and so on and so forth. They're very interesting, but they're very tricky. Sorry. So you can make scenarios here to see how much your application would cost, but I didn't do any example because it differs so much, but you get the idea. And the second part for the fee is the insurance premium, of course. So the mortgage loan insurance premium, including any application surcharge, is an upfront charge to the lender, which represents the total cost of insurance a mortgage. The premium may be added to the mortgage and is non-refundable. Provincial tax cannot be added to the insured loan amount. For progress advance, the premium is due and payable by the lender to CMHC as the mortgage funds as advance. Okay, so basically you just heard it. You can put this insurance premium fee on your mortgage, but not the taxes. But I want to touch on that here quickly. So you remember before we did an entire scenario with different ratio, the value, the loan to value, the DCR. And I put here insurance fee with a 0 with a cross because we have not added this in the total loan here. But when we do add this to the total loan, then the DCR change because it's not the same capability of repayment. So you have basically a bigger loan, a bigger payment, and it's different here. So our criteria here at 1.30 was met. But now we have the insurance premium. Whatever the amount is going to be here, we were already flush here. So what's the solution? Is to add more of the down payment, or to find a way to optimize the revenue of the project. If not, if that criteria is not met, and we can play around or whatever, but most likely the loan's not gonna happen. So now on the screen, I'm gonna put another, I'm gonna move here. I'm gonna put another table. And this table is the standard rental housing when the market rent is met and not met, okay? And you're gonna see, basically there's a table for any type of insurance loan for CMHC. There's for MLI Select, which is another program. There's for a retirement home. The price of the certificate change depending on the class of asset, but you can see that it goes with loan to value. And in my example, we had a loan to value of 67%. And let's say that our rent was met. The price of the certificate would be 2.85% plus the extra amortization by slice of 5 years, starting at 25 years. So 5 slices plus 1.25. So that would be the price of the certificate. And you also have, well, the surcharge premium. First, the amortization expansion, the non-residential space, and the second mortgages. And I want to touch on the last thing, because this situation is going to happen down the road, probably next year or the year after, because honestly, MLI loan were not like, they were always a thing, but not as much as there is right now. And honestly, a lot of professionals are capable of feeding their kids because this program is here. But in case of, if you already had an MLI loan, it's possible that you want to refinance, okay, to pull some equity out. And how does that work? Because you already paid a premium, right? And it's non-refundable. Well, the premium credit for refinance of existing CMHC insured loan, the premium payable on refinance application is the full applicable rental premium on the loan, on the total loan amount, additional funds plus outstanding balance of existing mortgages. The borrower may be entitled to a premium credit if the refinance application is received within 7 years of a mortgage that was previously a CMHC insured. There's the other thing. It says the credit is not available on second mortgage surcharge and a minimum premium applies. So you basically have another table here. I'm going to put the table on the screen. But let's say you were in your CMHC loan for 4 years. You're basically eligible for a 50% credit on your premium. So that money is not entirely lost, but some of it is. The best thing to do with your CMHC loan is to just never break it. But then again, every life situation happens and maybe you need to do that, but yeah. And I also want to make a last justification in that video. There are two programs that are similar but very different for the CMHC, and it's the MLI standard, which we just demonstrate most of the conditions here, and there's the MLI select, okay? So these are almost the same name, but they're very different program. The MLI standard does not have to follow the TAL requirement in terms of increase of rent, okay? Whereas the MLI select has to follow the rental increase of the TAL if they have affordability standard, but this one does not, okay? So this is just the last justification that I wanted to do. So basically, that's pretty much where I wanted to go with that video. Please let me know in the comments what you think about the MLI program, if you think that it's good for the investor, for the renters, if you feel that it could be modified, what kind of modification you would do to it. If there's something in the video that I missed that you find that it's an important point, please comment below. It will just help other people to understand better. And also, if you want me to make another video on a specific aspect or so on for the CMHC or for whatever commercial loan, if I'm capable to do it, I'll do the proper research, I'll do it. And that's pretty much it for that part. If you have anything to say, put it in a comment. And if you would like to go deeper or analyze your personal project and you would like to book me for a meeting, go to capitalcentral.ca, fill up the small form on the contact section of the website and book an appointment with me for half an hour or whatever. And we will go over your project and see if it's doable or not. And if you need more than just a half an hour, then of course I am a professional that charge fees, so we'll have to look into that. But for the time being, I would like to thank you for being in this video, for following the video. And if you like the content, like, share, and subscribe. And also, if you want to have a specific video on a topic, like I said, I can do my best to make one, but for sure I will do other type of video on these types of loans. So thank you very much and have a good day.
Filter that down. Change the pattern a bit. I think we need a right symbol. filter that down. Change the pattern a bit. I think we need a right symbol. Filter that down.